What is bookkeeping and why it matters? Bookkeeping tracks all the financial transactions of a business, every bit of money that comes in, like sales, and every bit that goes out, like payments for rent, bills, and other expenses. It helps us see clearly how the business is performing and where the money is going. For example, a coffee shop records its sales as revenue. It also pays for rent, utility bills, staff wages and salaries, business insurance, and other daily expenses. The coffee shop owns assets such as cash, property, plant and equipment, and furniture and fixtures. It may also owe money, for example, bank loans, taxes, or unpaid bills. Also, the coffee shop has the owner's share of the business, which is money invested by the owner, plus profits kept in the business. Bookkeeping and accounting. They sound similar, right? But they actually do two different jobs, and both are equally important. Bookkeeping is all about collecting and recording financial data, basically keeping a detailed record of everything that happens in the business financially. So every time the business earns money, pays bills, buys stock, or spends cash, the bookkeeper writes it down. Think of them as the record keepers. They make sure every transaction is captured accurately and in order. Once all that data has been recorded, the accountant analyses and interprets it to make sense of the numbers. They look at the records, prepare financial statements like the profit and loss account and balance sheet, and then use that information to help make decisions. Together, they give us the complete financial picture of the business. In other words, they answer the question, what do these numbers actually tell us about the business? In business, transactions are classed as cash or credit depending on when payment takes place. Cash sale occurs when a business provides goods or services and receives the money straight away. For example, a customer pays instantly using a debit or credit card, bank transfer, or cash at the till. Credit sale takes place when a business supplies goods or services but allows the customer time to pay. The payment is made after an agreed period, such as 30 days. For example, sending an invoice that gives the customer 30 days to settle. Cash purchase happens when a business buys goods or services and settles the amount immediately. For example, paying for supplies in cash at the point of purchase. Credit purchase occurs a business receives goods or services from a supplier and agrees to pay at a later date. Example, receiving materials now and paying the supplier's invoice 30 days later. When running a business, there are two key groups you'll deal with every day: customers and suppliers. Customers are the people or other businesses who purchase your goods or services. Some customers pay right away. These are called cash customers. Others might be given a bit of time to pay. These are known as credit customers. For example, imagine a company selling office furniture. If someone walks into the shop, pays by card and takes their desk home, that's a cash customer. But if a company places a bulk order and is given 30 days to pay the invoice, that's a credit customer. Now, let's look at suppliers. Suppliers are the people or businesses that provide goods or services to your company. Some suppliers require payment right away. We call them cash suppliers, while others allow you to pay after a certain period, called credit suppliers. For instance, if you buy printer paper from a local store and pay at the counter, that's a cash supplier. But if you order office equipment from a wholesaler and agree to pay next month, that's a credit supplier. So, in short, customers bring money into the business. Suppliers are the ones the business spends money on. Every business stands in the middle of two flows: money coming in from customers and money going out to suppliers. These are called receivables and payables. Receivables represent the amounts that customers still need to pay the business for goods or services they've received on credit. Think of it like this. When your business makes a credit sale, you've earned income, but haven't yet received the cash. The customer now owes you, so the business records this as receivables. Imagine your business sold 50 bike helmets to a retailer with 30-day payment terms. Until they pay the invoice, that amount is part of your receivables, money you expect to come in soon. On the other side, we have payables. This refers to the money that the business itself owes to its suppliers for goods or services bought on credit. When a company makes a credit purchase, it receives the goods first and agrees to pay later. The supplier becomes one of the business's creditors because the business has an obligation to pay them. These amounts are recorded in the purchases ledger, which tracks each supplier, the amount owed, and the agreed payment date. For example, your company buys new bike parts from a wholesaler on 30-day credit terms. Until that invoice is paid, the balance appears in your payables, money due to go out in the future. In every business, transactions don't just happen. They're recorded, verified, and supported by documents. These documents create a paper or digital trail that shows what was agreed between the buyer and the seller. They confirm what was ordered, delivered, and paid for, and help both sides track progress, check accuracy, and sort out any issues if something goes wrong. The purpose behind them is to keep transactions transparent, accurate, and traceable. Let's look at the main documents used when businesses buy and sell goods or services. A price quotation is usually the starting point in a sale. It's a document prepared by the seller that lists the items or services offered, along with the prices, terms, and conditions. It gives the buyer an idea of how much something will cost before they decide to place an order. Purchase order. Once the buyer decides to go ahead, they send a purchase order to the seller. This document confirms what goods or services are being ordered, the quantity, and sometimes the agreed price. The invoice comes from the seller once the goods or services have been provided. It's an official request for payment and includes details such as what was sold, the date, the total amount, and when payment is due. The invoice forms a key part of a company's accounting records because it shows what income is expected. Goods received note GRN. When the buyer receives the goods, they issue a goods received note, often called a GRN. This document confirms that the items ordered have arrived and are in good condition. It's used to check that what was delivered matches the purchase order and that nothing is missing or damaged. Credit note. Sometimes mistakes happen. Maybe the wrong goods were delivered or some items were damaged. In such cases, the seller issues a credit note. A credit note reduces the amount owed by the buyer, correcting the original invoice. It's a way to show that the seller has accepted the return or the adjustment. Remittance advice. When the buyer makes a payment, they often send a remittance advice. This document tells the seller which invoices are being paid and the amount of each payment. It helps the seller match incoming payments to the correct invoices, especially when there are multiple transactions. Cash receipt. Finally, when payment has been received, the seller provides a cash receipt. This is proof of payment. It shows that the money has been received and the transaction is complete. Cash receipts are important for both the buyer and the seller's accounting records. In this lesson, we're going to look at really important accounting terms: assets, liabilities, equity, revenue, and expenses. Let's start with assets. These are things the business owns, like cash in the bank, property, computers, or equipment. Basically, anything that has value and helps the business run. Next, we have liabilities. These are the things the business owes. Money that needs to be paid back. It could be loans, unpaid bills, or credit card balances. Capital, also called equity, is the owner's stake in the business. It shows how much of the business the owner actually owns after adding what they put in and subtracting what they take out. There are two main parts. First, owner's investment. This is the money or assets the owner puts into the business to get it started or help it grow. And second, profits kept in the business. When the business earns a profit and the owner leaves some of it in the business instead of taking it out, that increases equity. Then we come to revenue. This is money coming into the business, usually from selling goods or providing services. In the UK, sales, revenue and turnover all refer to the money a business earns from its normal trading activities. In accounting, we usually use the word revenue. And finally, expenses. These are the costs of running the business. Things like rent, utilities, cleaning, insurance, staff wages and salaries, and so on. By keeping track of these categories, what the business owns, owes, earns, and spends, we can clearly see how the business is doing. Every business tells a story, and that story is written in numbers. In this lesson, we're going to learn one of the most important stories: how a business earns a profit or makes a loss. Your revenue is the amount a business earns from selling its goods or services, even if the customer pays at a later date. Expenses are the costs a business has to pay in order to run and operate. If the business earns more than it spends on its running costs, the difference is a profit. But if the running costs are higher than what the business earns, that difference becomes a loss. Here's a bakery that sold bread worth £1,000. That's their revenue. They spent £700 on flour, rent and wages. Those are expenses. So £1,000 minus £700 equals £300. That's their profit. Now look at this case. They earned only £600, but their expenses were £800. So £600 minus £800 gives us minus £200. That's a loss. They spent more than they earned. This is exactly what happens in every business, from a small cafe to a big company. Profit arises when revenue exceeds the costs required to run the business. When the cost is greater than the revenue generated, the business reports a loss. So remember, profit isn't just a lucky number. It tells you how well the business is being managed. One last thing, a business can make money from other small sources, like interest, rental income, profit from selling equipment. These are called other income, and they also increase profit. In this lesson, we're going to look at owner's capital and the balance sheet basics. Let's start with something simple. Imagine you're starting your own small bakery. You put in £3,000 of your own money to buy equipment and ingredients. That money you invested is called owner's capital. It's the amount the owner puts into the business to get it started or keep it running. Now, as soon as the business starts, we can describe what it owns and what it owes. That's where the balance sheet comes in. The balance sheet shows three things: what the business owns, called assets, what it owes, called liabilities, and the part that belongs to the owner. That's the owner's capital. These three always stay in balance, and we show it as a simple equation. Assets equals liabilities plus owner's capital. For example, if your bakery owns £5,000 worth of assets and owes £2,000 in loans, the remaining £3,000 belongs to the owner. That's your capital. So remember, the balance sheet is called a balance sheet because both sides always have to equal each other. It's like a set of scales. When one side changes, something must change on the other side too. The accounting equation is the foundation of all bookkeeping. It shows that everything a business owns, assets, is financed by either what it owes, liabilities, or what the owner invested, owner's capital. Accounting equation formula: assets equals liabilities plus owner's capital. This means the two sides of the equation must always stay in balance. Let's say the owner puts £5,000 of their own money into the business. What happens? The business receives cash, so assets go up by £5,000. At the same time, the owner's investment increases, so capital goes up by £5,000. See, both sides of the equation increased equally. Next, imagine the business buys a computer worth £1,000 but doesn't pay immediately. The business now owns a new asset, the computer, so assets go up by £1,000. but it also owes £1,000 to the supplier. So liabilities go up by the same amount. The equation still balances. Now, the business pays off £500 from a loan. That means cash goes down. So assets decrease by £500. The amount owed also goes down. So liabilities decrease by £500. Again, both sides fall equally, and the balance is maintained. Next, the business earns £2,000 from sales. That means cash increases. Assets go up by £2,000. At the same time, profit increases the owner's share. So capital goes up by £2,000. The business is growing, but the balance still holds true. Finally, the business pays £300 for rent. Cash decreases, so assets go down by £300. That rent is an expense, which reduces profit. So capital goes down by £300. Both sides decrease, and the equation stays equal. So in every example, something goes up and something else goes down. That's why the accounting equation always stays balanced. Every transaction affects two accounts, but the total always matches. That's the magic of double-entry bookkeeping. In an accounting system, financial information isn't all recorded in one place. Transactions are stored in different books or records, depending on their type and purpose. We call these transaction locations. Let's look at the main ones you'll encounter. Books of prime entry. These are the first records in which a transaction is written down, the starting point of the bookkeeping process. Examples include Sales Daybook for credit sales, Sales Returns Daybook, records goods returned by customers, also called returns inwards, Purchases Daybook for credit purchases, Purchases Returns Daybook, records goods returned to suppliers, also called returns outwards, and Cash Book for cash receipts and payments. Here we have an example of a sales day book, which records all goods and services sold on credit to our customers. Each line shows a separate sale during the month. For example, on the 4th of January, the business sold goods to Bright Home Interiors for £850 net, plus £170 value-added tax, making a total of £1,020. Now, let's look at the Purchases Daybook, which records everything the business bought on credit from its suppliers. On the 3rd of January, for instance, the company purchased office supplies from Office Pro Supplies for £620, net plus £124 value-added tax, giving a total of £744. Here's a summary overview of the main books of prime entry used in bookkeeping. The Sales Day Book records all credit sales made to customers. The Purchases Day Book records all credit purchases made from suppliers. The Sales Returns Day Book records goods returned by customers. The Purchases Returns Day Book records goods returned to suppliers. And finally, the Cash Book records all receipts and payments made by the business. This includes both cash and bank transactions. Now that we've looked at the daybooks or books of prime entry, such as the Sales Daybook, Purchases Daybook, and the Cash Book, we're ready to move into the next stage of bookkeeping, the General Ledger. This is where transactions are summarized and categorized to show the financial position of the business. The General Ledger is the central record of all financial transactions. It includes assets, liability, equity, revenue, and expense accounts. Think of it as the master book that contains a summary of all financial activity. The General Ledger forms the basis for preparing the trial balance and eventually the profit and loss account and balance sheet. Subledgers, also called subsidiary ledgers, keep the detailed transactions for specific accounts. They support the General Ledger by showing how each total is made up. The Sales Ledger shows each customer and what they owe. The Purchase Ledger shows each supplier and what we owe them. The General Ledger holds the totals, and these subledgers hold the details. Prime entry books are Cash Book and Petty Cash Book. The Cash Book records all cash received and spent, and the petty cash book records small day-to-day cash expenses. The receivables ledger, called the sales ledger, keeps track of money owed to the business by its customers. Each customer has their own individual account. Whenever goods or services are sold on credit, that transaction is posted here. When customers make payments, their accounts are updated to reduce the balance owed. In summary, it shows who owes the business money and how much. The payables ledger, also known as the purchase ledger, is the opposite of the receivables ledger. It records money that the business owes to its suppliers. Each supplier has an individual account. When the business buys goods or services on credit, the amount is recorded here. When payments are made to suppliers, the balances are reduced. This helps the business manage its liabilities and cash flow effectively. The cash book records all money received and paid out of the business, whether through physical cash or through the bank. It often serves a dual role. It acts as a book of prime entry, where transactions are first recorded, and it also functions as part of the ledger system because it contains the actual cash and bank accounts. You'll usually see two main columns: receipts, debits, showing money coming in, and payments, credits, showing money going out. The petty cash book is used for recording small, everyday payments, such as postage, stationery, or minor office supplies. It's controlled by a system known as imprest, where a fixed amount is kept in hand. When small expenses are paid out, the total is reimbursed to bring the balance back to the original imprest amount. This makes it easy to monitor and control small cash transactions. Every transaction in business has two sides. In accounting, we record both sides so that our books always stay in balance. This method is called double entry bookkeeping because each transaction is entered twice, once as a debit and once as a credit. A ledger account is shaped like a T. The left-hand side is for debits, the right-hand side for credits. Think of the debit side as what the business owns or spends, and the credit side as what the business owes or gives away. This keeps the accounting equation in balance. Assets equals liabilities plus capital. Let's take an example. The business buys a computer for £500 cash. Now, what's happening here? The business is getting a computer, which is an asset. When an asset increases, we debit that account. So we record debit equipment account £500 because our equipment, or assets, have gone up. But at the same time, the business is paying cash. That means the cash the business owns is going down. When an asset decreases, we credit that account. So we record credit cash account £500 because the cash asset has reduced. Notice how one side increases and the other decreases, and the two amounts are the same. That's the key rule in double entry bookkeeping. Every transaction has two sides, and the total debits must always equal the total credits. You can see two T accounts side by side. On the equipment account, you write £500 on the left side, the debit side. On the cash account, you write £500 on the right side, the credit side. If you add up both sides, the total still balances. One debit, one credit, same amount. Paying utility bill increases expenses, debit expenses, and reduces the bank balance, credit bank. The business gains a new asset, office desk, so the asset account increases, debit. Bank, another asset, decreases, so it's credited. Drawings are money taken out by the owner. They reduce the owner's capital, so they are debited. The business takes loan from the bank. Liability increases, credit, and receives cash, asset increases, debit. Selling goods increases sales revenue, credit, and increases the bank balance, debit. The business receives money. Asset increases, debit bank, and the owner's investment increases capital, credit capital. To remember how each type of account behaves, it helps to understand what increases or decreases them. Debit side. Assets. When the business owns or receives something of value, we debit the asset account. Example, buying equipment or a vehicle. Expenses. When the business spends money or incurs a cost, we debit the expense account. Example, paying rent, wages, or electricity bills. Drawings. When the owner takes money or goods out of the business, we debit drawings because it reduces capital. Example, the owner withdraws £500 for personal use. Credit side. Revenue. When the business earns money from sales or services, we credit revenue account. Example, making a sale or earning service income. Liabilities. When the business owes money or takes on a debt, we credit the liability account. Example, taking out a loan or buying on credit. Capital, owner's equity. When the owner invests money into the business, we credit capital because it represents the owner's claim on the business. Example, the owner invests £2,000 to start the business. In summary, debit increases assets, expenses, drawings. Credit increases revenue, liabilities, capital. Remember, every debit must have an equal credit so that the books always stay in balance. What is account coding? Coding means assigning a unique number to each account in the chart of accounts. Think of it like a postcode system for your finances. Every account gets its own location number so it can be found, grouped, and summarized easily. These numbers are called account codes or nominal codes, and they make it much faster to enter transactions consistently, sort or filter accounts by type, and prepare financial statements automatically. Why coding is useful. Consistency. Everyone in the finance team uses the same numbering system, so for an example, code 6000 means wages, not something random. Speed. You can post transactions quickly without searching long account names. Reporting. Codes help your software instantly group totals for assets, liabilities, revenue, and expenses. For example, if all expense codes begin with 6, you can easily pull out all your costs by asking the system to total anything that starts with 6. In this table, we can see how each account in the business is given its own account code and category. For example, bank account has the code 1000, which falls under current assets. Money the business owns. We use different code ranges for different types of accounts. Assets and liabilities, both current and non-current. Cost of sales and overheads for running costs. Administrative expenses, revenue accounts, and owner's equity, which shows how much the owner has invested in the business. How it works in practice. Let's say we're recording a transaction for office rent. Instead of typing office rent expense every time, we can simply type code 7000. The system knows this means rent expense. If we then record utility expenses under 7,100 and insurance under 7,200, our software can easily produce a total for all accounts in the 7,000 to 7,999 range, which we know represents administrative costs. There's no legal rule saying your bank account must be 1,000 or your capital must be 3,000. These are just conventions, agreed upon structures that make it easier for accountants across businesses to read ledgers. A company might decide to start its sales at 4,000, while another might use 100 for the same purpose, and that's fine, as long as it's consistent throughout that system. In larger businesses, codes can have more detail. For an example, 7000-01 might mean office rent, London branch. 7000-02 could mean office rent, Manchester branch. The first part of the code shows the type of expense, and the second part identifies the department, project, or location. Let's look at what those codes represent in real terms. Every code belongs to one of two big families in accounting, assets and liabilities. This is where the coding system connects directly to the double entry system. In accounting, we divide assets and liabilities into short-term, called current, and long-term, called non-current categories. Current assets business owns or expects to use or turn into cash within a year. Examples: bank balance, cash, accounts receivable. Non-current assets, also called fixed assets, are assets the business uses for longer periods, usually more than a year. Examples: equipment, vehicles, buildings. The same logic applies to liabilities. Current liabilities are debts the business expects to pay off within 12 months, like accounts payable or short-term overdrafts. Non-current liabilities are longer-term debts, like bank loans or mortgages that will take years to repay. Now we use those assets, liability and equity codes, in real journal entries and T accounts. When a transaction happens, for example, the owner invests £10,000 and the bank grants a £50,000 loan, then the business buys computers for £6,000. Each of those accounts will appear in the ledger using their category-based codes. Example: the business receives £10,000, so cash in the bank increases. This is a debit entry in the bank account, code 1000. At the same time, owner's capital increases. That means the owner now has a claim over the business. This is a credit entry in the owner's capital account, code 3000. Business received £50,000 loan from the bank. Again, the bank account increases because we've received money, debit bank account £50,000. But now, the business owes that £50,000 to the bank. It's a liability, credit bank loan account £50,000. Business purchased computers for £6,000, including £1,000 VAT. The bank decreases because money is going out. Credit bank account £6,000. The business owns new computers, so our assets increased. Debit computers account £5,000, which is excluding VAT. The VAT on the purchase is recoverable, meaning HMRC owes us that amount. We debit VAT on purchases account £1,000. The double entry tables and T accounts show how all these coded accounts interact. Current assets increase debit side, while capital and liabilities increase credit side. Every transaction we record has two sides, one debit and one credit. Over time, dozens or even hundreds of entries are posted into the ledger. But how do you make sure everything has been entered correctly? That's where the trial balance comes in. A trial balance is a list of all the balances in the general ledger at a particular date. It is one of the key checkpoints in bookkeeping, helping us confirm that our entries follow the double entry rules. The trial balance is generated to, first, provide an overview of all account balances. It shows the balance of every account: assets, liabilities, capital, equity, revenue, other income, expenses, and drawings, all in one place. Second, check mathematical accuracy. If total debits equal total credits, it suggests the arithmetic is correct. Third, help identify mistakes. If the totals do not agree, an error has likely occurred in the bookkeeping process. And fourth, prepare for financial statements. Businesses rely on an accurate trial balance to produce income statement, called profit and loss, and balance sheet, called statement of financial position. A trial balance acts like a bridge between the ledger and the financial statements. Before we build a trial balance, we must understand how ledger entries are created. This takes us to the duality principle. It's the rule that keeps our books balanced and is the heart of double entry bookkeeping. In accounting, every financial transaction is recorded using double entry, and all accounts fall into 5 main categories: assets, liabilities, capital and equity, expenses and revenue. These categories determine whether an item is debited or credited. The duality principle tells us that every transaction has two sides. To record these, we use double entry bookkeeping. One account is debited and one account is credited, and the total debits must always equal the total credits. Whether a debit or credit means an increase or decrease depends entirely on the type of account. Transactions can fall into 4 different duality patterns. First duality pattern is increase on both sides. For an example, the business buys equipment worth £2,000 on 30-day credit. Equipment, which is an asset, increases, debit £2,000. Trade payables, which is liability, increases. Credit £2,000. Both sides of the accounting equation increase. An asset rises and a liability rises, but debits still equal credits. Second duality pattern is decrease on both sides. For an example, the business repays £500 of a bank loan. Bank, which is an asset, decreases, credit £500, and loan payable, which is liability, decreases, debit £500. So here we have both sides decreasing. The asset goes down because cash is paid, and the liability goes down because the loan is reduced. Third duality pattern is increase and decrease on the same side. For an example, business sells old equipment for £150. Bank, which is an asset, increases, debit £150, and equipment, which is an asset as well, decreases, credit £150. In this case, both entries sit under assets, so only one side of the accounting equation is affected. One asset rises, another falls, and the books still balance. And fourth duality pattern is increase on one side and decrease on the other. It happens when we pay for something or when money leaves one part of the business and becomes something else. For an example, business pays a rent expense of £300. Rent expense increases, debit £300. And bank, which is an asset, decreases, credit £300. By following the accounting equation and the debit-credit rules, we keep financial records accurate and balanced. Now let's practice how all of this looks in real accounts. We'll post the transactions into T accounts and then bring them together in a trial balance to check that everything adds up. Imagine we're looking at a few real documents, an invoice, a supplier bills, and some bank transactions. These are everyday business events. Our job is to turn them into accounting entries. The plan is, first, we'll take each transaction and decide which accounts it affects. Second, we'll record it into our T accounts. Third, we'll total everything up and check that our trial balance still balances. Basically, we're turning business paperwork into balanced numbers. Our first transaction, the owner puts £10,000 cash into the business. Which two accounts are involved? Bank and owner's capital. Let's post that in our T accounts. The bank increases, so we debit bank. Capital increases, so we credit capital. Next, the business takes out a £50,000 loan from the bank. That increases our bank, so debit bank. This increases our loan, which is liability account, credit loan. Then we buy computers for £9,600, including £1,600 VAT. So, debit computers £8,000, asset account. Debit VAT on purchases £1,600. And credit bank £9,600, asset account. We paid for our office supplies £500, so our double entry will be debit office supplies £500 because our expense increased, and credit bank £500 because our cash decreased. Office supplies is an expense, and expenses always increase on the debit side. The bank account is an asset, and assets decrease on the credit side when we spend money. Now, let's look at another transaction. The business received £2,000 for services we've provided, and the money went straight into the bank account. The bank account is an asset, and assets increase on the debit side when money comes in. The service revenue account represents our revenue, and revenue increases on the credit side. Debit bank £2,000 because cash in the bank increased, and credit revenue account £2,000 because our revenue increased. Let's look at this transaction. Our client has paid £5,400 for an invoice we issued earlier for software we provided. The money is received into our bank account. Our accounts receivable decreases because the customer has now paid what they owed. Assets decrease on the credit side. Our bank account increases because cash came in. Assets increase on the debit side. Let's look at the utilities and rent payments. Business paid £300 for utilities and £1,200 was paid for rent. Both reduce the bank balance, so they appear on the credit side. Utilities is an expense, and expenses always increase on the debit side. So the £300 payment is shown as a debit in the utilities account. The same applies to the rent account. Rent is also an expense, so the £1,200 payment is recorded as a debit in the rent account. This shows the double entry principle in action. Each transaction appears twice: a credit in the bank account and a debit in the relevant expense account. Now that we've posted our transactions into T accounts, let's bring everything together in one place. This table is the general journal. It shows every debit and credit from all the accounts we used. When we list all the debits and credits together like this, the total debits must equal the total credits. This is a quick way to check that our double entry work is correct. To make it clear, we'll use the bank account as our example, since it has several transactions and is ideal for showing the balancing process. First, we total both sides of the account, all the debits and all the credits. Then, we calculate the difference between them. The total on the debit side is £67,400 and the total on the credit side is £11,600. The difference between them is £55,800. It's the balance that needs to be entered into the bank account to make both sides equal. The difference is what we call the balance carried down. This is entered on the side with the smaller total, so that both sides equal the same amount. Finally, we bring that balance forward to the next period. This is the balance brought down. It appears on the opposite side to where the balance carried down was entered. If the balance brought down appears on the debit side, it means the account has a debit balance. In this case, the business has money in the bank. If it appears on the credit side, it would mean the account is overdrawn. Balancing accounts manually helps us check the accuracy of our entries before moving on to the trial balance, which summarises all our accounts at period end. Now that we've balanced the accounts, we can take the closing balances and record them in a trial balance. The trial balance shows all the account balances at a point in time. In this case, after we've balanced the bank account. Each account appears once, with its closing balance shown on either the debit or credit side, depending on the account type. The total of the debit column should always equal the total of the credit column. If they don't, it means there's likely an error somewhere in the entries or calculations. The trial balance acts as a check for accuracy, making sure that every transaction has been recorded with equal debits and credits. Although it gives a snapshot of the accounts, its main purpose is to confirm that the bookkeeping is mathematically correct before moving on to preparing financial statements. Now that we know how the trial balance is prepared, the next step is understanding what can go wrong. Before we can correct mistakes, we first need to understand the different types of errors that can occur in accounting records. First type of error is reversal of entries. This happens when the correct accounts are used, but the debit and credit are swapped. For an example, we bought equipment for £1,000. Correct entry should be debit equipment £1,000 and credit cash £1,000. But the wrong entry was posted as debit cash £1,000 and credit equipment £1,000. The accounts are correct, cash and equipment, but the sides are reversed. Why this matters? The trial balance still balances, which makes the error harder to detect. However, the financial statements are wrong because the accounts show the wrong direction of movement. We have to correct a reversal of entries error. The correction has two stages. Step 1. Remove or reverse the incorrect entry by simply doing the opposite. Debit equipment £1,000 and credit cash £1,000. This cancels out the mistake and returns both accounts to where they would have been if nothing had been posted. Step 2. Post the correct entry. Correct entry should be debit equipment £1,000 and credit cash £1,000. We do it in two steps because a reversal error means the original entry is backward, so we must undo what was done and record what should have been recorded. Removing the original mistake ensures the accounts reflect the true position. Second type of error is error of original entry. Error of original entry is when the wrong figure is recorded from the very beginning. An error of original entry happens when the correct accounts are used, but the amount itself is written incorrectly when the transaction is first entered in the books. This means the mistake starts at the source. For example, the invoice, receipt, or instruction was read incorrectly or mistyped. Once the wrong figure is entered, that same wrong figure gets posted throughout the accounting system. For an example, the business was meant to record £12,500, but the amount was mistakenly recorded as £1,250. The transaction is still between the correct accounts, but the value is wrong. Corrections follow a very logical process. Step 1. Reverse the incorrect entry. We post the opposite: debit bank £1,250 and credit rent expenses £1,250. Step 2. Post the correct entry. Now enter the transaction with the right amount. Debit rent expenses £12,500 and credit bank £12,500. This two-step method clears the books of the incorrect figure entirely. It makes the correction transparent and easy to audit. Next type of error is error of principal. When a transaction is posted to the wrong type or class of account, an error of principal occurs. The amount is correct, but it is posted to the wrong type of account. This breaks accounting principles. The trial balance still balances, but the financial statements become misleading. For an example, the business pays £400 for office stationery, like pens and paper, but the bookkeeper accidentally posted it as if the business had bought a new office desk, which is a non-current asset. Wrong entry was made: debit office furniture £400, which is a wrong type of account. The amount is correct, £400 was paid, but it was posted to the wrong category of account. To correct this error, we will remove the incorrect entry and post the correct entry. Since bank is correct, we don't reverse the whole entry. We simply credit office furniture £400 and debit stationery expense £400. Bank remains untouched because it was correct. We fixed only what was posted incorrectly. Next type of error is error of commission. Error of commission is when the entry is posted to the correct type of account, but to the wrong specific account within that category. The amount is correct, the debit and credit direction is correct, but the bookkeeper chooses the wrong actual account. Simple example: the business pays £150 for cleaning supplies. Correct expense account is cleaning expense, but the bookkeeper accidentally posts it to postage expense. Wrong entry made: debit postage expense £150, credit bank £150. Bank entry is correct. The only problem is the wrong expense account was used. We don't need to reverse the whole entry. We only fix the wrong expense account: credit postage expense and debit cleaning expense. Next type of error is error of omission. Error of omission is when a transaction is completely left out of the accounting records. Nothing is entered in any ledger. Because both debit and credit are missing, the trial balance still balances, making the error harder to detect. For an example, sales invoice omitted. A sales invoice is issued to a customer, ABC Limited. Net amount is £1,000, VAT £200, total is £1,200. Correct entry should have been: debit trade receivables £1,200, credit sales £1,000, and credit VAT output £200, but the invoice was never entered in the accounts. This means ABC Limited shows no amount owed, sales are understated, VAT return is incorrect, profit is understated. How to correct an error of omission? Since nothing was entered, there is nothing to reverse. We simply need to post the correct entry in full, as if doing it for the first time. Debit trade receivables £1,200, credit sales £1,000, Credit VAT output £200. Another type of error is compensating error. A compensating error occurs when two separate errors happen in the accounts, but they offset each other, so the trial balance still balances. Individually, each error is wrong, but because one error increases or decreases the total on one side and another error increases or decreases the total on the opposite side by the same amount, the trial balance appears correct, even though the underlying accounts are not. These errors mask each other and make the books look right when they are not. Let's look at two unrelated errors. Error 1. Electricity expense was supposed to be £300, but the bookkeeper posted £200. The debit side is understated by £100. Error 2. Sales revenue was supposed to be £5,000, but only £4,900 was recorded. The credit side is understated by £100. Result of these, debit is £100 too low and credit is £100 too low. They cancel each other. Trial balance still agrees. To correct the understated electricity expense and sales, we debit electricity expense £100 and credit sales £100. Let's summarise the 6 types of errors that do not affect the trial balance. Even though these errors are all different, they have one important thing in common. The debits and credits still add up to the same total, which means the trial balance will still balance, even though the accounts are wrong. Error of omission. The whole transaction is simply missing. Nothing was posted at all. Error of commission. The right type of account was used, but the wrong specific account, such as choosing the wrong expense account. Error of principal. The transaction went to the wrong category of account, for example, treating an expense as an asset. Error of original entry. The correct accounts were used, but with the wrong amount. Reversal of entries. The accounts are correct, but the debit and credit have been posted on the wrong sides. Compensating errors. Two completely separate errors happen, but they cancel each other out, so the trial balance still balances. These are the key errors that don't impact the trial balance, which is why we can't rely on a balanced trial balance to mean everything is correct. A trial balance can agree, but the accounts may still contain mistakes. There are a few types of errors that affect the trial balance. These are older, manual bookkeeping errors. Modern systems normally prevent them, but you still need to recognize them because they explain why a suspense account may appear. A suspense account is used temporarily when the trial balance doesn't balance, holding the difference until the errors are found and corrected.